All right, well, let's dive right into it. So we got NASDAQ, S&P 500, and of course, Dow futures are also lower here this morning. Again, this is taking place while we actually have the VIX lower in the pre-market. VIX has been up first two sessions of this trading week. Got above 19 yesterday, bordering on 20. There's still obviously the potential for the VIX to get to 20. VVIX has also been climbing here recently, and after breaking down and closing below 100, I think a week ago, got down to, I want to say, 96 and change, and now has since popped higher. We'll take a look at VIX futures term structure because today is VIX futures expiration day. The front month April VIX futures contracts, they close, they expire at 7 o'clock a.m. Central Time. So expiring as we speak, actually. So this front month contango, this no longer really exists. This is actually the front month now, the May futures contract. So this will update today. Basically, this will be off the board, the April futures contract. And this is the first official trading day here of the May VIX futures contract being the front month contract. 27 days in this particular calendar cycle. So it is a shortened or condensed calendar cycle for the VIX futures. I like those cycles. I hate the long ones, which April was at, I think, 34 days. I like the more condensed cycles. We're starting this one with 7.5% contango. That is high contango, clearly not as high as the former one got to, but to be expected. So this is still the ideal risk assessment when it comes to shorting volatility. UVXY, VXX, we saw UVXY hit a high yesterday, 514, on the day before collapsing, as you can see, closing at $4.88. Slight bid here this morning. Again, even though the VIX is down slightly, right now when it comes to VIX futures, yesterday's closing price on that back month was 21.05. Right now, it's 21.10. So it's bid up 5 cents. As VIX futures go, the price of UVXY goes. It is not as the VIX goes, the price of UVXY goes. It's not how it works. The assets under management are VIX futures. Looking at pro shares for UVXY, just checking in on the assets under management to see if they've actually sold out of all of the, sometimes there's a lingering 1,000 or 2,000 contracts left on the final day of the that expiring contract. And no, they're out of it, completely out of it. The only thing they own now are the May futures contracts, 74,000 worth, and of course the swaps from Goldman Sachs. So they've completely sold out of the April futures contracts as of yesterday, and to be expected. So as this contract goes, UVXY will go today. Right now, it's up 10 cents from yesterday's close. We do see a slight bid here in UVXY. All right, well, let's get to it. 2 days in a row, we're down in the S&P 500. That's the first back-to-back decline that we've seen here in the month of April. Something I noted yesterday. Not of terrible importance, but some of this activity, this consolidation that we see here this week was heralded over the last 2 weeks as we've seen the RSI getting above 70 for the S&P 500, signaling that we are indeed overheating. And then there's just a variety of breadth metrics, the percentage of stocks trading above the 200-day moving average, the percentage of stocks trading above the 50-day moving average. Speaking of that 50-day moving average metric, by the way, and let's see if we go to, because this is the one that we wanted to see, get to about 61 days in a row where it trades 80% of stocks above the 50-day moving average. Unfortunately, we dropped to 78% as of yesterday. So again, this breadth indicator is the percent of S&P 500 stocks trading above their 50-day moving average, and it fell from above 80. It was at 88% going into yesterday's trading session, fell to 78%. So it fell pretty hard. Although the S&P 500 itself, it was a decent decline yesterday, but it wasn't anything alarming. Here's where indices wound up yesterday. So almost 0.7% down on the S&P 500, but we lost a pretty substantial percentage for this breadth indicator. So unfortunately, that streak of 61 days will not take place here. We went 43 days with 80% or better stocks trading above their 50-day moving average in the S&P until yesterday it came to a close. So unfortunately, that breadth indicator, those statistics that we were looking at that signaled, forward-looking returns, if you get to 61 days in a row, we're just about positive. A month out, 3 months out, 6 months out, 12 months out. The positive forward returns for the S&P 500 are pretty strong, and the positivity rate was above 80% for each one of those time frames. But again, we're not going to get to 61 days this go around. We're still in a long-term uptrend. We still have a healthy amount of stocks trading above their 50-day moving average. So nothing really to worry about at this time. And when it comes to the long-term trend, the percentage of stocks trading above, this continued higher. A bit of a positive breadth divergence here, right? Because we had this stochastic actually move up, this breadth indicator, if you will, percent of stocks trading above their 200-day moving average. That's the longer-term time frame. Even though the S&P 500 fell yesterday, this particular breadth indicator went higher. So you won't see this on Twitter and the social media because it's positive. Twitter feeds off of negative bias or bearish bias, or FinTwit does. So this won't be promoted. But this is a positive breadth divergence. Is it of consequence? In my opinion, not terribly. But again, this does speak to the long-term trend of the market and potentially what you should be doing on these dips, these consolidation phases. So we'll kick that off the board there for now. Now we're up to 21.19. This probably speaks to the VIX actually. Yep, it's only down 5 cents now, and futures are getting worse here, and just about to hit 8:30, bottom of the hour. Verizon Communication post higher. Yes, this morning they had the CEO on CNBC as well. The stock, this is Verizon. Verizon at most is going to move maybe $1.50 on earnings day. Historically, that's just what it does. No matter whether it beats or misses, you get about $1.50 move on average. Even when they beat, the stock just kind of flounders about. But over a 90-day period, it tends to move in the direction that the earnings are moving. If earnings are growing, which they generally are for Verizon, the stock generally moves higher over that 90-day period post the ER. So another good report there for Verizon. Stock has already had a decent move heading into earnings. It was recently down in the 55s, now 58s. Golden Capital portfolio, we own Verizon long term. Walmart here this morning. Now, consumer staples yesterday had a very healthy bid. All the defensive sectors led the market yesterday. They were all positive. Healthcare, consumer staples, utilities, and real estate. All 4 defensive sectors were positive. The dollar was positive. Bond yields. But they weren't buying bond yields in droves, but a little buying pressure there in the back half of the day. Crypto was bid, gold was bid. A lot of the so-called safe haven and or inflation protection assets yesterday were bid while the broader markets came under pressure. So there was definitely a flight to safety yesterday. And we didn't see a lot of the buy the dip activity. We did see a healthy bid in the final hour of trading, kind of ease some of the consolidation that happened through the majority of the day. We actually saw that on Monday as well. The final 10 minutes on Monday, we saw a surge into the close, but it was the final hour yesterday on Tuesday that we saw pretty decent bid, keeping us off of the lows of the session. Low of the session yesterday for the S&P 500, I believe it was 41.18. We finished at 41.34. NASDAQ was under greater pressure than the large cap indices, amongst the large cap indices, down 0.9%. Dow Jones, you can see there, S&P. What led the way to the downside was the Russell, down almost 2%. One of the things that we've been talking about a lot lately here was the gap in performance between tech and or NASDAQ and the Russell. One of the reasons why is because this tends not to last. That gap that we've seen open up, the gap that was opened up was about a 13% difference between the year-to-date performance in the NASDAQ versus the Russell. And Russell, or small caps, materially outperforming. And that's what these two charts here basically identify. This was as of March 14th, when the spread was the widest, 13.1% difference here between the two, with the NASDAQ in red. I'm sorry, the Russell in red and the NASDAQ in green down here. 13.1 spread. But if we look at it where it resides today, it's only a 3.8% spread as of right here. We've known for a while, we've looked at the data, we knew that this was going to happen. We had written about it in our weekly research reports in the past, denoting this performance issue and how the NASDAQ eventually catches up. It's just a matter of when it catches up. We were looking at this data here, relative performance of the Russell 2000 versus the NASDAQ comp. And historically, when you get this kind of a performance, the NASDAQ catches up over a 100-day period. And once the NASDAQ catches up and moves exorbitantly higher compared to the Russell, guess what happens after that? The Russell catches up over the next 100 days. That's just the way it has worked historically. So again, we knew this was unsustainable. Everybody talked, well, the value trade, the small cap trade, that should, continue leading the market in 2021. People get wrapped up in this recency bias and they forget about history. And they decide, no, this time is different in that respect. Well, the circumstances are always different, and we always appreciate that component of being an investor and understanding that it's always different. But in terms of investor behaviors, that's like the one true constant, which is why the market tends to, repeat history, if not rhyme history. So year to date, the Russell is still leading, but man alive, has the NASDAQ. And it's not just that the NASDAQ has risen, off of this bottom here and, kind of a W shape in the NASDAQ. But as it has risen, we've seen the Russell, express more, a little more than a 10% correction. We do expect over the next, it's a 100-day performance historical data that we look at. And I do expect this. So we've got about 85 days left. And my expectation is that the NASDAQ will close this gap completely and show some outperformance over that 85-day period. Inflation, right? Oh, gosh. This conversation is just not going to end. Folks, this inflation conversation is going to persist for some time. Kind of want to show you something that, again, in our not sure when the date with this report, our last research, April 11th, was our last official research report. And that was the week that the PPI data came out and it was hot, right? I mean, everybody was expecting a hot number, but it was above also the consensus economist estimates for the producer price index. So this tweet here that I put out earlier this morning, this is me when traders suggest inflation is the reason that equities will be the one asset class that won't participate in kind, meaning everything else will inflate but the stock market. Is that really how it works? That's really the logic that traders are using to avoid buying dips, to avoid buying the market. We've been in this reflation. I don't want to use the term inflation because I don't believe in inflation. I get it. Healthcare, premiums go up. House prices go up. The price of college tuition goes up. Like, I get that. I'm not exonerating that there are pockets of services and or goods that can inflate in price. But in that understanding is also the truer definition of the word. Inflation is something that has to sustain upward price movement. It has to be sustainable. The whole of the measures of goods and services does not exhibit inflation. It can exhibit or express bouts of reflation that ultimately subside to disinflationary conditions because they can't sustain that upward price mobility, if you will. But in the context of this conversation here, we've seen in the past where you get producer price index higher, you get CPI, the consumer price index higher for brief periods of time. But really only one time have the equity markets actually come under pressure. And it wasn't because of those inflationary conditions. It was, broader concerns, more macro concerns. Here's the PPI. Here's a chart of the PPI. This is 1982, 1983, folks. And we know, for those of you who are students of market history, 1982, 83, 84, 85, the market did nothing but go higher, really strong advance. In fact, into 1987, where you finally had its own kind of flash crash, if you will, Black Monday, as it's referred to now. But, this is looking at all the periods where the producer price index was above 4.5%. This was 1982, because our reading just came in at 4.5% as of last, or 4.2% as of the last producer price index reading. So this looks at all the times when it was above that level throughout history, going back to 1982, and the market was strong. Here 6.6, 5.6, 4.3, persistent. From February of 82 to basically March of 82 there. Market was higher. Here's another example. If we go back to 02, 03, 04 time period, here in 04, 5.1%, 4.3, 4.3, 4.7. Again, for those of you who are students of market history and you remember, the 03 through, up to 07 period, what happened in the market? We went higher. Again, looking at bouts of reflation and kind of dismissing the whole inflationary hyperbole, the market goes higher. Really the only time in recent history that we saw the market go lower where PPI and or CPI was higher was in 2000. 2001. But was that the reason? Was the inflationary components in the economy the causation of the markets succumbing to pressure? No. I mean, everybody remembers the dot-com bubble happening, or bursting, if you will, in 2000. And everybody remembers, the kind of the prolonged deterioration in the market until ultimately the Fed had to step in, lower rates, but we also shortly thereafter had 9/11 in 2001. In 2001, the beginning of 2001, we had a reading of 4.9%, but we still had the residual factors at play from the dot-com bubble bursting. This was really the only time where we had the producer price index above 4.3% on an annualized run rate and the market under pressure. Not causation here. So the whole, inflation, and that's why I'm not buying stocks. Really? It's going to be the one asset class that you think is not going to appreciate in value? It just doesn't make a lot of sense. All the fear mongering out there about inflation, when you put it under the microscope and you think about it logically, and then you support it with data like this, it's easy to dismiss. It's easy to dismiss. You need to look elsewhere for reasons not to buy equities, not to buy the dip. You need to look elsewhere because it's not in the inflation data. That should not be your reason for not buying the dip. So again, a couple nice, looks at the market here. We had the Apple event yesterday. This morning you had Tony Sakanawa with yesterday evening, his dissemination of the notes regarding, the event, what he thinks about the iPad lead times, the new product lineup and what have you. But I think, really all you have to do is look at his big takeaway right there on the heading. He still maintains a sell rating on the stock no matter what. Now, he's always been bearish on this, so take it with a grain of salt, as they say. Tony Sakanawa has always been bearish on Apple. He's the one stalwart, if you will, but he has been forced to raise his price target repeatedly because he's always behind the curve. I'm not saying that, Apple is going to beat earnings, beat the bottom line and rise in share price once it reports on April 28th after the closing bell. I'm just saying, Goldman Sachs analyst has been behind the curve when it comes to Apple. I own Apple. I'll continue to own Apple. I'd actually appreciate another opportunity for the stock to consolidate and buy more on the dip. But we'll see how it all plays out, of course. Again, breadth has been pretty poor recently, and we noted this. We talked about this here in the trading room, that more than likely stocks are going to make new highs, or if the indexes are going to make new highs going forward, it's probably going to happen on weaker breadth than in the past. Why? Because we just looked at the Russell and we saw small cap Russell index is under pressure. It's going through its version of a consolidation, a 10% at least garden variety correction. We'll see if it develops into something worse, but for now, small caps are not participating to the extent that they had been. It's a pretty sizable part of the market, but mid caps are not participating as much either. So if indeed, the S&P 500 consolidation is over down here at 4120s, if you will, and then we make a new high, it's going to come on weaker breath because small caps and mid caps are not participating to the same degree. This particular chart is the S&P 500 small cap index, the SML, and you can see it's dropped and closed below its 50-day moving average here. Again, this speaks to what we just saw in the percentage of stocks trading above their 50-day moving average in the S&P 500 itself, falling below 80%. So this is a big reason why. And this is why I say we shouldn't expect the same breadth that we've seen in the market over the last several months to show up all of a sudden once again. There's rotations going on. There's profit. People are locking in profits. Right now, it's a matter of waiting to see if they not only lock in profits, but where are they moving it to? If we look at yesterday's price action, we know that investors got defensive. They were buying staples. They were buying utilities. They were buying real estate. They were buying healthcare. Technology tends to be, safety as well. It's actually an all-weather index or sector, industry of the market, tech is just about everything. It's growth, it's defensive, you name it. Sometimes it's where you're going to find yield, so on and so forth. It's high beta. Tech is everything. But going forward, as I was just mentioning, we should not be looking for the same type of breadth that we've seen in the past. Semiconductors making a new high, kind of switching our attention here really quickly. Again, I want to look at a number of charts here this morning. This particular one is the Philly Semiconductor Index, ETF, if you will. Or you can look at the SMH, which is the Vanguard ETF. But this one is the semiconductor ETF that made a new high. After this high here and this consolidation phase, it made a new high here. Right now, it's just below its 20-day moving average there. If we look at where the 50-day moving average might come in, because it has been consolidating again here. It's actually just above its 50-day moving average right now. So we made this new high, but what was this a false breakout? Because that's kind of the conversation or narrative that you'll see a lot of people start mentioning, that this was a false breakout. Just like I don't believe in overbought, the market can get over. I don't believe in that terminology, because if the market just goes higher over time, how could anything be overbought? It can be overextended based on time. It can be overextended. But then overbought, again, doesn't really make a lot of logical sense, that term, when characterizing something that just goes higher over time. It's a matter of being overextended or overheated based on a limited time frame seems more sensible, a better characterization, if you will. But making a new high and just going right back into a consolidation phase is going to bring out those narratives again that promote the idea that this was a false breakout, making new highs. The reality is you can go back time after, this looked like a breakout here, right into consolidation. But, a month later, we're making new highs again. This looks like another breakout, right into consolidation. But we made another new high. This, again, you could have said, false breakout. Test the 50-day moving average. Test the 50-day moving average. Broke below. Spent some time below the 50-day moving average this go around. This was a more intense correction for the semiconductors. Breaks out, makes another new all-time high. Here we go again, testing the 50-day moving average. Not there yet, but maybe today is where we do test the 50-day moving average, break below it possibly, close below. Remains to be seen. Technicals, as always, they don't tell you the future. It's just about analyzing what has already taken place in the market and understanding it's a developing situation here. Missed the opportunity. 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 Need I say more? Are you going to miss this opportunity, right? And don't get me wrong, it could still go lower in price. What's the overarching point here, though, when you're looking at the chart of the of the semiconductors? You want to go back 2 years? Go back 2 years, right? You want to go back 5 years? Go back 5 years. What's the point here? This is the big picture, folks. You can either place trees, plant trees in front of yourself, create obstacles for not buying the dip in the long-term trend here of the semiconductors, or you can appreciate the fundamentals that are driving semiconductor performance over time and just say to yourself, I don't need the perfect price entry. All I need is time. That's really all I need, because when you understand where companies are spending money, you understand the fundamentals belying these charts. Where are they spending money increasingly over the years? This is technology spending. This is chips. This is software. This is cybersecurity. This is cloud computing. They're spending it in technology more so than they are hard machinery, trucking, and things of that nature. Technology spending is going to outstrip hard machinery CapEx spending going forward. Market is a forward discounting mechanism. It's going up, folks. So again, just looking at the 1-year chart here, you make the call. Maybe you want to wait for that 50-day moving average. Maybe that's what a lot of people want to see happen. And when a lot of people are leaning in that same direction, what tends to happen? The market likes to disappoint as many people as possible, right? So, I wouldn't be so, I wouldn't confine yourselves to trying to get the perfect entry, regardless of what we're seeing here in the way of the technicals, just my opinion. All right, so good chart there. Pepsi upgraded this morning via UBS. Upgraded to a buy, raises their price target. I want to say mid 150s is where they raised the price target. Again, staples yesterday, strong. We had Walmart higher in a pretty red tape. We had Costco higher in a pretty red tape. Coca-Cola, Pepsi higher in a pretty red tape. Pepsi upgraded today. Had good earnings, beat on the bottom line, beat on the top line. They offer their guidance. They call it their algorithm, and they basically said their algorithm didn't change, meaning they didn't lower or raise guidance. The reality is, though, they actually did raise guidance a little bit when it comes to the bottom line, not the top line, but the bottom line. So within that context, you got an upgrade here. We've seen several upgrades recently, or at least price targets raised recently on shares of Pepsi. Let's look at the chart of Pepsi because it's very informative. I know a lot of our members here in the trading room are probably about to pull out their hair because I said the exact opposite yesterday. And don't pull out your hair. I'm being sarcastic. There's no information here. None. Look, this is not normal behavior for a stock. I mean, this is pretty, you get pretty steep peaks and valleys here, folks. We went from 143 close on 9/2, September 2nd, to this trough level here. Broke below on an intraday basis, broke below 130 before closing at 131 on the day. So again, right here, 143 close. And within a matter of a couple of weeks, you had a break of 130. That's almost a 10% correction in a matter of 3 weeks. And then you rise roughly 3 weeks later to an intraday high of 144. I mean, that is price volatility galore. And then you have another steep drop here, only to make a new all-time high here, basically to end the year. Yay, right? Good year, especially given last year, right? And then it gets bad. And when it gets bad, it gets real bad. Pepsi reported, again, for the fourth quarter of 2020, which is what it reported back in February, beat on the top line, beat on the bottom line. No change to the algorithm. Didn't matter. Stock still fell and fell significantly. Another 15, 17% correction there. On nothing but earnings beats and revenue beats. Nothing changed in guidance. It's a consumer staple stock. I looked back on history. I looked at all the different sectors. because I wanted to know what the efficacy rate was when it came to individual sector follow through. So if I'm looking at the technicals for the technology sector ETF, ticker symbol XLK, right? Or I'm looking at the technicals for the retail sector ETF, XRT, or I am looking at consumer staples, ticker symbol XLP. I looked at all 11 sectors within the S&P 500. And when you look at the XLP, if you're, we dropped below the 50-day moving average. No, we rose above the 50-day moving average. When you look at those kind of support and resistance levels, if you will, based on moving averages or just general technical patterns when it comes to the consumer staples ETF, and you're trying to gauge, okay, based on this technical formation or this achievement in, a bullish move or a breakdown in a bearish move, your expectations going forward are XYZ. This is going to happen next based on what we see has happened in the technicals and what has been developing. But with the consumer staples ETF, the follow through, what you expect to happen usually based on that technical analysis, doesn't come to fruition more often than any other sector ETF, meaning that the XLP, for whatever reason, it's got to be compositional, obviously, the stocks that are held within the XLP, for whatever reason, the XLP has the worst follow-through efficacy rate. And you look at a stock like Pepsi here, and you can see why. It doesn't have a lot of rhyme or reason. Clearly doesn't, in shorter time frames, doesn't really follow what the fundamentals are outlining, right? Beats and beats and beats by Pepsi. Doesn't mean a whole hell of a lot. You go and look at a stock like, well, let's do that. Let's do a comparison with Procter & Gamble, PG, right? There you go. It had outperformance here, clearly, Well, not really. I mean, there's some level of likeness here, definitely. A perfect spike in both of these right here. This one had more pressure, being that it's also in the beverage category. So it's not the broader consumer staple, but the the sub-industry, beverages. So it had an even worse performance, but it's almost a mirror image. You had a nice rise here, equates to a nice rise there. Nice dip here equates to a nice dip here. It's basically the same thing. Same chart we're looking at. Again, consumer staple stocks just don't have a lot of technical follow through. They're either in favor because maybe, we're moving from one stage of the bull market cycle to the next stage of the bull market cycle. So as we get later into, the latter innings of a bull market cycle, staples tend to do better. But when you're early in a bull market cycle, it's about cyclicals. It's about, being offensive versus defensive. Staples are defensive. As you move into the latter parts of a cycle, however, you get more outperformance from staples and defensive sectors than you do in cyclicals and growth sectors. But just like Pepsi, Procter & Gamble shows the same relative performance over time. It's because of the sector, and it's just because of style rotations throughout a bull market cycle that leads ultimately to, a cyclical bear market. So take this off the board. And yes, we could look at, the 50-day moving average here, and we want to. And, with this latest move, and look how robust this move and swift this move is, which again just points to, these defensive stocks, you really should get to love them. These have a firm place in your portfolio, in my opinion, for eternity. These are your comfort stocks. These are the ones that tend to outperform during a bearish move in the market, right? It doesn't mean they'll go up. It just means that if the market's going down, bringing everything down with it, these won't go down as much. But more importantly here is the names in the consumer staples: Procter and Gamble, Johnson & Johnson, Pepsi, Coca-Cola, I can get Altria, I can go down a whole list of them. These stocks generally get it done over time. They grow earnings, they grow revenue over time. They're just tried and true companies. They're consistent earners. They have good dividend yields. When they do dip, because they're out of favor based on just the market cycle, there's such good buying opportunities. A lot of people learned that when Pepsi dipped down here and broke below 130, briefly broke below 127 on an intraday basis one of these days here. It did. I should know because I had bought it briefly and flipped it out. But when they get down there, they are opportunity. Yeah, but I bought up here. Okay. Do we know exactly when the market is going to say, that's it, defensives, you're out of favor for the next 30 days? No, we don't know that. Hold on to it. Collect your dividend. Pepsi's giving you $1 plus per share every single quarter just to hold it. You're holding a company that is going to pay you to hold their stock. Plus, the company continues to deliver on the top and bottom line consistently, quarter after quarter after quarter after quarter after quarter. And when it gets going, it really gets going. So I held here, and I had to suffer through this. It's one way of looking at it. The other way of looking at it is, man, this was such a fantastic opportunity. I got paid my $1.02 per share just to hold it. And the market, because of the investor community belief that defensive areas of the market, defensive industries and sectors should be out of favor, the market gave me this huge opportunity to buy this stock at basically a 15 to 17% discount from where it had been. Had you taken that opportunity? This is why. Again, I just showed you the Procter & Gamble chart. You could have done the exact same thing with Procter & Gamble, or just bought the XLP, the Consumer Staples Index, if you don't want to be a stock picker. Just keep in mind, you're probably going to lose out on the dividend component of this. But here's the XLP, which did also, just like the Consumer Staples stocks, the individual stocks made a new all-time high as the defensive stocks came back. Procter & Gamble reporting yesterday, nice beats, raising prices because of commodity inputs, cost inputs. The stock actually started down on the day, about $3, rallied and finished strong and was positive on the day. I missed buying it by just a scotch. So again, Pepsi back above its 50-day, Procter & Gamble, Coca-Cola above their 50-day, the XLP itself above its 50-day nicely. Having said that, usually when it gets this far above its 50-day, usually when it gets this far above its 50-day, usually when it gets above this, and then it wouldn't surprise me near term. Either we're going to have, a more protracted move like this one here, or we're going to have some near-term consolidation like this here when it comes to consumer staples. Right now, with the overall market consolidating, and still in consolidation, what appears, this morning, not at the worst levels of the pre-market, but still down. Defensive may still, have the bid. It may still have the bid amongst investors. So we've looked at semiconductors, we've looked at consumer staples, we've looked at Pepsi, has the bid here today. Netflix delivered earnings last night. Beats on revenue, slight beats. Beats on the bottom line, top line, but subscriber growth was a substantial miss. In the after-hour session yesterday, Netflix dropped to the 480s. Here in the trading room, we did talk about it as we were going into the close. Some of us were, active. in the after-hour session. I did manage to buy some shares here in the after hours. There it was, 404.59. And it moves so quickly in after hours. I literally turned around. My daughter was asking me this, that, and the other. I came back a few minutes later, at 3 minutes later, and the stock was in the 490s. I cut bait, took my profit, and ran. It's still bid down here in the pre-market. It's carrying a lot of the NASDAQ down, of FANG stocks down with it. We're down about $17 on the bid there in Amazon, $11 on the bid there in Google. Facebook, more than likely, same thing, down about $1 here. And Apple bid down as well, even after Apple event there yesterday. Any news on Apple? Probably nothing of great consequence. Tesla also, will get wrapped up in it because of its heavy NASDAQ component. So that's getting some selling pressure as well. Futures here, we don't know if this is going to persist. We could just as easily see, when the market opens, all of these losses in the futures completely erased. I am of the opinion, however, we do have VIX futures expiration here. Usually we do tend to see a bit of a spike on expiration more often than not. 13 out of the last 18 VIX futures expiration days, we've seen the VIX move higher by 8 to 10% on that particular day, which is today, 13 out of the last VIX futures expiration days. Clearly that's not perfect, and there's no guarantees that we will get a spike here today, but we are already up now. 27 after being down about 40 cents, we'll call it cents here, in the VIX in the 7 to 8 o'clock hour. All of a sudden we've started to move higher as futures have edged lower. So a lot to look at here. One of the things that I also don't want to ignore, because it comes out every weekend. When I say it comes out, he tweets it out just about every weekend. April 19th, actually, the most recent. The mystery broker went to a short-term sell on stocks at Friday's close by Michael Santelli. I think this is grotesque. You're talking about, somebody who has thousands upon thousands of followers, 73,000 followers. He has his own blog and basically his own subscription service through CNBC. He's a host on CNBC. He gets a lot of attention. He gets a lot of people that will see this and will decide for themselves that, well, they better start hedging, or they better start selling stocks. Many a times he's started this whole mystery broker thing. And he says that the mystery broker is somebody who used to work with at Barron's when he was a columnist at Barron's. And he's relying on that person as a source of information that he tweets out week after week after week. And many times in the past where the mystery broker has offered a short-term sell signal, it has completely failed. So I just kind of want to bring that to attention, because that's what people will do. I think this is grotesque because you have a Twitter audience that isn't, I shouldn't blanket that make a blanket statement that every Twitter user, FinTwit user, is unsophisticated, uneducated, and can't discern for themselves, what's going to happen in the market next. But, if we are to generalize, there's probably, a large population of Twitter users that will see this and say, I better sell, or maybe I should short the market. And what do we know, when it comes to this kind of market timing calls? A, it's a bad discipline. B, the market can, become overextended longer than most people think. But again, he's been saying this for a while. This was from a report that I did on December 9th. When, again, the mystery broker comments, and you can go to Michael Santelli's Twitter, back during that week of December 9th, 2020, where he was saying, short-term sell signal. And here was also a comment or an exchange he had with somebody who was commenting on his mystery broker tweets and saying, well, this reminds me of the end of 2017 into 2018, and he agrees. Have made the same point and made the same point often, and much of the sentiment positioning setup resembles keyword setup resembles January 2018 conditions. And at the time we were seeing, the bull bear spread and the AAII surveys, showing, pretty good bullish sentiment along with the NIME exposure index in the 100s, right? I mean, those are pretty bullish sentiment readings. Chiming in also, Mark Newton. Those who are ignoring the warning signs now with their cognitive dissonance will likely fail to see or understand why stocks turn down. And yes, it's been right to be bullish. How one analyzes the tape and manages money largely depends on one's time horizon and risk tolerance, which is true. Your time horizon, I mean, what do you care if somebody issues a short-term sell signal if you're only thinking about the end of the year or you have a 3-year time horizon? It doesn't mean a whole lot. Unfortunately, though, again, when you have as many followers as these people, they see this as warning signs. They see this kind of commentary as warning signs. We remember what happened from January to February 2018, Volmageddon, a 5% drop in the S&P 500 in one day. VIX goes up to 50 before settling out at 35. Again, so making comments like that, this is a setup that resembles January 2018. Imagine if you had sold in December because of this kind of commentary. Imagine if you had sold. Right? You missed out on, melting up through the end of the year. We finished, 3750 on the S&P 500, and where are we now? We almost got to 4200 on the S&P. Imagine you had sold because of this kind of commentary from Michael Santelli and the warning signs because of your cognitive dissonance from Mark Newton. Your time horizon is all that matters. It's not about timing the market. It's about time in the market. So when you see these comments, really it's buyer beware. Are you buying into this? Buying into this commentary, Not buying the market, but buying into this kind of fearful narrative. If the market pulls back, it's not because of the mystery broker saying it should pull back. We've been talking about it for the last couple of weeks. I mean, the title of our research report back on April 11th is Preparing Stock Market Correction, Sharpening Up My Buying Power. We understand based on the breadth readings getting to certain extremes, the leverage and the NIME, the AAII bullish percent getting to extreme levels, the market itself, the S&P 500 RSI getting to above 70, getting to 73. That's overheated. We had 95% of stocks trading above their 200-day moving average, which we still have, by the way. We had 90% of stocks trading above their 50-day moving average. And these are overextended, overheated conditions that eventually result in some type of consolidation. How much, we don't know, don't care. All we know is that we don't generally spend a lot of time, with RSI at such levels before we start to see the market do a little bit of consolidation. RSI above 70, we don't stay here long. RSI above 70, we don't stay here long. RSI above 70, we don't stay here long. As of yesterday, the reading came down to 63. My expectation is that, we got some round number collision potential here. 4,100 on the S&P, a 20 handle on the VIX. I think that's probabilistic. I'm open to being wrong. I'm actually hoping to being wrong as well. But it remains to be seen. Either way, the long-term trend, as denoted by the amount of stocks trading above their 200-day moving average, still being at 95%, tells you should be a buyer of dips. How much consolidation is going to take place? Nobody knows. Nobody knows. It's a guesstimate at best. So just execute your game plan. What are you buying on the dip? All right, segueing to our NASDAQ.com, 1998 to 2000 analog. We're right where we should be, folks. We are right where we should be as of 420. We got on the elevator. We're taking the elevator up. We could deviate. Don't get me wrong. We were supposed to dip here, but we ripped. We dipped here instead, which we caught up, and we're not up as much as we were in 1998 here, but we are still up. We're traveling along the same path from time to time. We're simply on a different time plane, but this is still in effect. And this harkens back to, do you really think that human behavior has changed all that much in the markets? Do you think that small caps are going to outperform NASDAQ, growth, so on and so forth, tech? I'm not of that opinion. And I could be wrong. The analog could be proven wrong. These are not guarantees. But until proven otherwise, you lean on the side of probabilities. All right, looking at the 10-year minus the 2-year, our treasury yield curve here, we dropped a little bit yesterday. This is, again, another buy the dip signal. The yield curve's not inverted. It's pretty steep. It's the steepest we've seen since 2015. This tells you, buy the dip. We flattened the yield curve about 2 basis points as of yesterday. Here we are with respect to high yield credit spreads, another buy the dip signal. Are credit spreads blowing out? If they're not blowing out, if the yield curve is steepened, buy the dip. Plot twist, the mystery broker is his imaginary friend. That's the other thing that I think is very disgusting. To kind of promote these market calls, but hiding behind the veil of somebody else is giving you these calls. I think that's disgusting as well. But that's just me. So. Anyways, all right, folks, we got about 15 minutes here now until the market opens. Wishing everybody a great trading day. Come join us here in the trading room at phenomgroup.com.